Have you fell into a trap like this wherein you have been stepped out of the market too early due to hitting of your stop loss even into the winning opportunities? Then, don't worry, this video will help you in solving out this problem. So, in this video, we would dive deep into the concepts of the moving average, and at the last, we would reveal the highly effective moving average strategy. Now, before we move on into our video, if this is what that interests you, then don't forget to like the video and be sure to subscribe the channel to never miss out any of our upcoming videos that are been uploaded on the channel. Now let us move on into the video. Firstly, let us learn some of the basics of the moving averages in order to understand the strategy properly. The moving average is the average of specific candles. Like in the 50-period moving average, the average of previous 50 candles is calculated. And then, if the price goes above the average of 50 candles like it went here, then the price would stay above the moving average line. And similarly, if the current price goes below the average of its previous 50 candles, then the price would stay below the 50-period moving average line like it did in this example. The moving average line is used by both short-term trader and long-term investor. The difference is just into the period of moving average. The short-term trader generally uses the moving average period line between 9-period and the 50-period. While the medium-term trader uses the 100-period moving average line for finding buy or sell opportunities into the market. And similarly, the long-term investor uses the 200-period moving average as the price reaches at this level only when the price is highly oversold or overbought. The 50-day moving average line, in a trending market, provides a support to the price. The short-term traders have an aim of going long during the time of pullbacks into the trending bullish phase. Through this moving average line, they can easily do it. The short-term traders can buy the currency pair at the lower price and sell it at a higher price, which would help them in maximizing their profits into the market. And also, if the price goes below the 50-day moving average and reverses, then the 50-day moving average line provides a resistance to the price. But this thing does not work during the ranging markets. Similarly, the 100-period moving average is used along with the 50-period moving average by the medium-term traders. The 100-day moving average is helpful when the market either makes a big pullback or a short-term reversal. The market usually makes the big pullbacks or short-term reversal during the end of a bullish or a bearish trend. The short-term traders also uses the 100-period moving average if the price goes below the 50-period moving average in an uptrend and vice versa in a downtrend. The confluence of 50-period EMA and 100-period EMA is also useful during the time of reversals entry. Let us see how this confluence of 50 and 100-period exponential moving average would help us in earning profits during the reversals. So, here as you can see that the market is in an uptrend. And then the market made a change of character here by going below this higher low. Thus, the price went below this 50 and 100-period exponential moving average line. We would mark the areas of point of interest into our chart. So, here we can see that a support zone was created here, and now, the market is coming at this zone. The market went below this level and now is coming back to this level. The price reached at this zone, and along with that there is a crossover of 50 and 100-period exponential moving average line, which is why there are higher chances of market respecting this level and continuing its downtrend. We would go short into the market from this point. The stop loss would remain above this 50-period moving average line. Let us wait and see how the market reacts. The market continued its downtrend, and thus, we made huge profits by using this confluence of 50 and 100-period moving average line. And similarly, the 200-period exponential moving average line helps us in buying from an oversold zone and selling from an overbought zone. Whenever the market comes closer to the 200-period exponential moving average line during a trending phase, then it means that the market would continue its phase in the future. The long-term investors often use this 200-period exponential moving average in order to find out buy or sell opportunities into the market. The medium-term investors also uses this 200-period exponential moving average when the price goes below the 100-period exponential moving average in an uptrend and above the 100-period EMA in a downtrend. The strength of a trend can also be determined through this moving averages. Let us see how it can be determined through an example. So, the market is making higher highs and higher lows here. We can see that it's a clear uptrend, but this could be a short-term uptrend too. So, in order to determine that whether it will continue in future or not, we need to use these 50 and 100 period exponential moving averages into our chart. So, here we have all these two moving averages. We can see that there is a huge gap between the 50-period exponential moving average and 100-period exponential average, which indicates that there are a lot of buyers into the market. And also, both the lines are going upside, which is why we can say that this is a strong uptrend. After analyzing this trend of the market, we can conclude that this uptrend would last into the future. Similarly, in this example, we can see market making higher highs and higher lows, which indicates that the market is in an uptrend. But there is not a huge gap between both the exponential moving averages, which is why we cannot go long into the market, as this can be a short-term reversal also. Due to all these reasons, we can conclude that this is a weak trend, and which is why we would not find the areas from which we can go long into the market. Same happens during a downtrend. But both the moving averages have problems in them also. Like if a short-term trader is using 21-period moving average alone to trade into the market, then whenever the market goes below this 21-period moving average line in an uptrend, the trader would have losses. We can understand this thing properly through this example. The market has made a pullback and has reached at this 21-period moving average line, which is why the short-term traders would go long from this point. But the price is seen hitting the stop loss of their trade. This is where the concept of moving average crossover would help us. The crossover of the two or more than two moving averages helps us in finding the correct areas from which we can go long or short into the market for maximizing our profits. Along with that, the moving averages crossover also helps us in knowing when to exit our long or short trade into the market. Let us see how the crossover would help us from facing losses into the market. So, here we have an uptrend due to market creating higher highs and higher lows. The 21-period exponential moving average is providing a dynamic support to the price. After seeing this happening for 2 times, the traders would go long once the price reaches at this line again. The market is making a pullback and it has finally reached to the 21-period exponential moving average line. Now let us see what happens to their long trade. The market went below the 21-period exponential moving average line, and the 21-period EMA line went below the 50-period EMA line. This is where most of the traders gets trapped. The impatient traders would initiate their long trade once the price reaches at this 21 EMA line. Instead doing so, they should wait for the market to make some bullish move to confirm that this 21 EMA line would provide dynamic support to the price this time also. And also the 21 MA line crossed the 50 EMA line to the downside, which indicates that a reversal might occur very soon. And after reaching at this line, the market made some bearish candles. And thus, we would go short from this point. The market went below, which helped us in making nice profits. Now that we have learnt all the basic concepts of the moving average, let us move to the strategy of the moving average, which would maximize our profits into the market. So, in this strategy we would use the top-down analysis in Confluence with the moving averages. Firstly, we would move to the higher time frame for identifying and plotting the key levels on our chart, and after that, we would go to the lower time frame for confirmation and taking entry. Let us now begin with the strategy. Here we have the gold chart on 4-hour time frame. We will use the 21 and 50 period exponential moving average line into our strategy. We can see that the market has made a support zone here as it respected this zone for 2 times. And now the market has came at this zone for the 3rd time. But we would not enter from this point. Instead of that, we would first go to the lower time frame and then we would wait for the market to meet these two conditions in order to confirm that a bullish trend would start very soon into the market. The first condition, which is creating some big bullish candles, is met here as the market created these bullish candles here. The second condition, which is the crossover of the 21-period exponential moving average above the 50-period EMA, is also met after some time. And thus, we would go long into the market from this point. The risk-to-reward ratio would be 4:1. The market went above and we made nice profits into the market. Through this strategy, you can earn more by using the trailing stop loss. It means that when the price is about to reach at your target level, you would move your stop loss to break even in order to increase your profits into the market. This brings us to the end of this video. In this video, we shared the best moving average strategy which would help you in increasing your profits. But we recommend you to backtest your strategy before using it out for your trading. And also, if you found this video informative, then hit the like button and be sure to subscribe our channel and hit this bell icon to never miss out any of our upcoming videos.